I just got back from our 2025 MoneyShow Masters Symposium in Sarasota, and it was one heck of a conference. From stocks and bonds, real estate and alternatives, we covered it all. And I sat down with some of our top speakers to get their economic and market takes in between sessions at the Ritz-Carlton. In this week's double-barreled MoneyShow MoneyMasters podcast, you'll get hot-off-the-press takes from José Torres, senior economist at Interactive Brokers. Learn what's powering the economy now and what to expect in 2026, why the bull market could last the rest of this decade, and how prediction markets are shaking up the trading world. Then discover the strategy and methodology that Steve Ho, senior researcher at Bloomberg Index Research, uses to uncover powerful market opportunities. I'll give you a hint. It has to do with a new way of looking at companies that face earnings challenges. Enjoy. Coming to you from the MoneyShow Masters Symposium in Sarasota. Today I'm speaking with José Torres, senior economist at Interactive Brokers. Jose, how are you?
Doing great. Great to be here, Mike. Always terrific to be part of the Money Show, especially in such a great facility here at the Ritz-Carlton in Sarasota.
You're a little disappointed, right? You think these digs, right? No, I know. We're happy to be here. We love it. Great property, great weather. What more can you ask for? Jose, talk a little bit about your presentation. You said you called it bullish through the decades. I mean, that kind of... Are you really that bullish? And if so, why?
Yeah, I think that the broadening trade that I've been looking for in the past few years, it didn't manifest this year. We're still having some sluggishness in the Russell 2000. It's some of the more cyclically oriented, value-oriented areas of the market. I think that those areas are really going to start to contribute to much more positive upside in the major indices in 2026 and 2027, allowing the Mag 7 to not have to post unbelievable numbers to carry the market further. I think that the concentration is going to be alleviated next year and the year after. Part of it is going to be rate cuts.
Okay.
That's going to disproportionately benefit those areas of the market that have weaker balance sheets. Also, when you consider the fact that I think that the lower and middle income consumer, they're poised to rebound in 26 and 27.
Okay.
Those areas of the market are in a better stance to benefit from that, whereas the Mag 7 darlings aren't necessarily that sensitive to monetary policy or to the consumer, for that matter. Recently the story's been all about AI capital expenditures. It's not really that cyclical. It's more of a futuristic kind of idea. So that's really where the earnings growth is going to come from. I think you get a rate cut here in December, 3 rate cuts next year. I think the 10-year gets down to around 3.50 sometime next year. Inflation comes in roughly around 2.5 in the first half of next year. Right now it's at around 3. I think fiscal stimulus, the big beautiful bill, lighter taxation, milder regulations, those tailwinds are going to become more pronounced next year. Consumers, lower income, middle income, those areas of the market, I think, poised to benefit.
Okay, got it. So we got a broadening market. We've got, the regulatory issues. We've got the Fed. But I do want to talk about the thing you brought up, and that's this AI issue. I mean, so many people are questioning bubble, boom, bust. What do they have to worry about? What are your thoughts on that?
Yeah, I think that the valuations are definitely stretched, but when you extend them a little bit, if you go out to a 3-year horizon, and the justification for doing that is that these companies have fortress balance sheets, they're not necessarily that sensitive to the economic cycle, to monetary policy, so you can extend that a little out. 3 years. And when you extend the earnings, the projected earnings out 3 years, the forward P multiple traditional is 12 months, go 36 months, you find that the earnings yield is actually, it's not that expensive. It's actually quite, it's quite well priced. And, if you take a longer term horizon, those stocks aren't that, they're not that expensive. But on the 12-month period, of course, they certainly are.
Okay, one of the other issues people have brought up here is this whole K-shaped economy issue, the haves, have-nots, whatever. What are your thoughts on that? Is that going to be something that we need to be worried about? The fact that, a lot of the population or what have you is not really participating in the economic boom or strength?
I think that differential has widened out so much that we're due for some kind of reversion.
Okay.
And I think that next year, that's going to start to become a little better when you have rates come down. So really, when rates are high, a lot of those borrowers, they have there's more of a multiplier on those higher rates, on those credit card rates, on those mortgage rates, on those personal loan rates. There's more of a multiplier. So when you get, let's say, 100 basis points of rate cuts from now through Christmas of next year, that can translate to a lot of those loan products 3, 4, 5% of interest rate alleviation,
okay.
And that should allow them to better service their debts and also stimulate the economy as well. So I think that Another big thing, Mike, is that they're not saving for homes because homes are way too out of reach, and that really allows their budget to spend in other areas, albeit we know that they've been under pressure. Black Friday was pretty good. It beat expectations.
Absolutely. I'm glad I wasn't stuck in a Best Buy at 7 in the morning for sure.
Mike, almost everybody, it was all online for the most part. That's really what drove the beat. It was online, brick and mortar, traditional retail shopping malls didn't see that much activity. Folks were scrolling and clicking.
Got it. Okay. Let's put on your hat and sort of project out to 2026. I mean, how bullish should somebody be for this year? You think we've had 25 plus years percentage gains for the S&P. We're at 14-15% as we're talking now. I mean, how bullish is bullish? Is it double digits, single digits, more? What are we looking at?
Well, inflation's at 3%. I'm thinking low double digits, around 11 or 12%. We will get another 20% a year in the future, but right now I think things need to calm down a little bit. We need to get those 12, 13% gains. I think that's what I'm looking for because the valuation situation, it's not ridiculous, but it is a little stretched. So, the bar to go higher does get harder and harder. But when you have the Fed Mike, they're going to turn around, they're going to start adding to the balance sheet in 3 to 4 months. In around April, I'm projecting they're going to start adding to the balance sheet. That is tremendous valuation support for equities. The Russell 2000, like I was saying in my presentation earlier, still below the 2021 highs because back then rates were 0 and now the Fed's, around 3.5 or so. So if you get those 100 basis points of rate cuts, you could have the Russell 2000 start to rally, and then we can start focusing on not just the Mag 7, but a more broader aspects of the market.
Got it. And I have to bring it up because it was, towards the tail end of your presentation, you talked about prediction markets, some ways people can trade this market and trade more than just the stock market than they used to be able to. How does that work? For someone watching this who may not be familiar with it, what's sort of the brief explanation of these things and what you can do with them in your portfolio?
Yeah, here at Interactive Brokers, a lot of our investors, they're engaging with these new prediction markets that we got approval for in August of 2024, so a little over a year. Essentially, there's yes and no contracts. The pricing on the yeses and the nos correspond to the probability. So a yes can be 70 and a no can be 30, whichever side's right gets $1 back. It's also interest bearing over time. So if you want a 12-month or 24-month contract, of course, a 70-cent contract would be the favorite. A 30-cent contract on the other side would be the underdog. Folks are really enjoying it. Fed decisions, S&P 500, NASDAQ, Dow, playing it. A lot of folks playing the dailies on that. Daily weather, believe it or not. Elections, Trump versus Harris, 2024, that was top contract. Fed decision I mentioned. House of Representatives, midterms. Right now, Democrats, 71% chance that they're going to win a majority. And it's been terrific. We've had quarter over quarter, triple-digit growth, number of instruments north of 8,000. We're a little later to the game versus our bigger competitors. We just started in late 2024, but we compete in a unique way because the major competitors in the space aren't big broker dealers like we are. So, we're working those synergies and looking to gain market share. But recently, it's been very buoyant. And we also compete in the traditional prime brokerage space in a bifurcated way. Yeah. We compete with the big banks, those brokerages, and we also compete with a lot of the retail brokerages. So we're a very unique firm looking to take market share and keep growing in all aspects that we can.
Today I'm speaking with Steve Ho, Senior Researcher at Bloomberg Index Research. Steve, how are you?
Oh, very well. Thank you so much for having me.
Yeah, glad we could be here. I hope you're enjoying the weather. It's a nice change of pace, I guess, right?
Absolutely. Lovely weather.
Well, Steve, why don't you talk a little bit about your background, what it is you do at Bloomberg Index, and then we'll cover a little bit about what you were covering here at the Money Show.
Oh, absolutely. Thank you so much for inviting me once again. And I am a quant researcher at Bloomberg Indices. I cover primarily systematic equity strategies, some of which we'll get into later. But what I presented today here at the conference. But I also sometimes do work in macro and asset allocation.
Okay, perfect. Now I know that you had a couple of different topics you could have chose to talk about, and yours was earnings inflection and talking about asymmetric opportunity.
Yes.
So maybe distill that in a minute or so. What that means if somebody didn't catch your presentation here.
Oh, absolutely, yeah. So this is an idea that I've been working on this year, and I'm quite proud of it. It's probably one of the best things I've ever actually worked on. The idea is to sort of distill this strategy that a lot of fundamental discretionary investors employ is how to actually catch companies that are not necessarily the high quality sort of quality compounders, but the downbeaten stocks that are sort of money losing even and been losing money for a while. But then suddenly they sort of show this sign of inflection where fundamentals improve and the stock re-rates much higher. And we have seen the sort of recent examples such as Uber or Palantir or Robinhood and some of these companies, just to name a few. And that's what motivated the whole idea as the intuition. And I wanted to convert this intuition into a systematic strategy in terms of that you're able to do that.
Okay, so you mentioned a couple names that sort of fit into that now. But I assume this methodology really can apply to almost any stock.
That's
any
right.
sector, right?
That's
So, hey, talk a little bit about the methodology. What is it you're looking for precisely?
Indeed. So it turns out sort of a simple way of capturing this earnings inflection is actually by watching the fundamentals improvement. In particular, I watch operating margin and net income as an example, and intentionally screen for companies that are currently running a loss, a net income loss. And then I look at the trailing 4 quarters and then 1 quarter forward using an estimate, the 5 segments of improvement. And if it's an improvement, I give it a score of 1. And if it's not an improvement or some worsening, I give it a score of 0. And I overweight the front quarters and I underweight the more distant quarters and create this sort of score out of 5. Right? If you have a company that's currently money losing and scores of 3 and better, right, it becomes an eligible candidate. Okay. And once it becomes an eligible candidate, if it continues to show strong improvement of having a score of more 4 out of 5 or more, it stays in the index. And indeed, as you just mentioned, while this thing sort of picks up often a lot of young tech companies that are money losing and sort of going through that phase of maturing, you also can pick up cyclical companies that's sort of industrial materials, energy, things that go through patches of a hard time.
Is there a way to avoid, or something built into the system that avoids this is a cheap stock that just keeps getting cheaper? Yes. I mean, that's obviously the value trap argument. How do you sort of screen for that?
This is almost happens mechanically. You get it for free because you're screening for a company that's already money losing. In other words, it's being priced probably with a lot of pessimism baked in. Valuation is going to reflect that, but also it's improving, so it's becoming less bad. And you will hold it only if it continues to show that steady, strong improvement. In other words, you're going to get out of the scenario in which a company is cheap for a reason where it's always going to stay bad.
Got it. Okay. And I know one of the other topics you were considering talking about was stagflation investing. Yes. I mean, looking at this environment, do you see it as stagflationary? How do you see this environment that we're all investing in evolving as we get closer to 2026?
So I gave a presentation in 2022 where I spoke about investing in the inflationary regime, and I talk about how sort of we are living in this structurally more inflationary environment, summarized by the 4 Ds that I call basically decarbonization, demographic aging, deglobalization, and finally dominance of fiscal policy over monetary policy. And I think we check all those boxes today. We are in a, I think, candidly inflationary environment. Now, stagflationary is not it's different from stagflation. We're not necessarily in a recession, but we can have disappointing growth that comes in less than expectation. We can have inflationary surprise to the upside that comes in stronger than expectation, such that you don't have to repeat the 70s in a verbatim fashion, have raging double-digit runaway inflation and recession for you to have a more stagflationary environment for which you want to look for assets that's consistent with such an environment. And indeed, what I wanted to talk about today, I didn't really get to manage to finish the research for, but hopefully in February when I come back, I will discuss it further, is you want to actually find ways of look for signals that look for stocks whose returns do well in the environment when inflation is surprising to the upside on average and when growth is surprising to the downside. And you can do that indeed systematically.
Okay, are there particular sectors, names you're comfortable mentioning that sort of fit your criteria?
Surprisingly, sort of this way of looking at inflationary investing is in contrast with traditional inflation investing, is that you're not looking for assets that are directly correlated with the level of inflation, which will put you in a lot of the energy sector, cheap value sector. Instead, you actually have a very decent size of exposure to technology and consumer discretionary, because stagflationary investing fundamentally is about productivity, right? You are looking for companies that is resilient to bad productivity shocks. In other words, when someone's asking you to pay them more for doing the same amount of work, right? Same number of work. Now that's actually a bad inflation shock. That's a productivity shock. And which companies and sectors are resilient to that? And what comes out of our analysis of looking at this correlation with the right surprise signals is that you actually want to have tech exposure with the right type of tech companies. That's not the money-losing super high valuation, but the quality tech companies.
And since you brought up technology, it's been a sector that a lot of our speakers are talking about, a lot of our attendees are asking about. Thoughts on what's going on out there, this AI boom bubble debate, and just the sector in general being, having shown such strong outperformance, but always people are wondering, is there going to be something else that's going to pick up the baton?
Actually, I quite liked what you spoke about this morning. I think that sort of pivot generally away more towards value and more towards, I think you mentioned metals, and that's actually, I think, the right core there. I think part of it is actually interesting. Everything is becoming the AI trade. The metals, the ones that are doing well, actually, if you look at it, lithium, battery, that's energy storage, copper for electrification, wires, and even silver goes into solar energy, which is actually, people don't know this, but the marginal kilowatt that's actually providing AI energy is actually all coming from solar and batteries. So everything has a bit of a latent AI factor. But to come back to what you were saying before, we've been on this, I think, ride of tech sector doing well, but what's really doing well within tech sector, if you look at it, the Max 7 is in good representation, is actually bidding up for valuation of high quality earnings companies, right? Okay. These are companies that are making so much money, right? They've created a profit machine. This is in sharp contrast with the dot-com bubble, where you had a lot more of a junk kind of exposure. Today is more about high valuation for quality companies that are highly profitable, that is becoming perhaps less allied. They're building all this capex, right? Becoming laden with a lot of hard assets, and perhaps depleting some of that cash flow with uncertain ROI. And this is the moment when you start sort of thinking about, perhaps you want to start looking at exposures in a different way.
Got it. Well, Steve, it's been a really enjoyable conversation. Appreciate you talking about some of your quantitative methodology and thoughts on the markets. Enjoy the rest of the show, and glad to have you.
Thank you so much, Mike.
Take care.